existing home sales this morning, coming in ahead of expectations and adding on to a good week for housing data. Let's talk about the sector and the home building trade. Michael Shaoul is back with us, Chairman, CEO, and Portfolio Manager at Marketfield Asset Management. Michael, so let's start with the survey, the home builder sentiment, as I know that's the one you wrote about this week in your letter to investors. Walk me through what we learned. What's new here?
Still extraordinarily high confidence amongst home builders, much higher than it was in the early 2000s boom. But the survey has come off from almost unanimous agreement that things were getting better to still a very high majority of home builders saying things are getting better, and it's almost impossible for a confidence survey like this to stay in the high 80s, where it was. But at 83, where I think, if I remember, it came in this week, that's still a massive majority. Strong regionally. We did highlight that the sentiment is a little bit weaker in the Northeast than the rest of the country, and that seems to be more about cost pressures than anything else. Land availability is limited in the Northeast. Labor availability is more limited in the Northeast than elsewhere. But generally, this is a genuine housing boom. The first genuine housing boom that we've seen in a half generation. And you're seeing the kind of data out of housing and the sort of contributions to GDP out of housing that anybody under the age of 40 really hasn't experienced in their adult lives.
So right now, we pull back a little bit from those records on the overall home builder sentiment. The orange line we were just looking at, the Northeast region, a little bit of a softer number there, pulling back, but we're still at these generational highs. And the boom you described, Michael, is it booming? Did it boom? What are the tailwinds here, and are they all still intact?
No, it looks like it's accelerating. I mean, in the new home market, you finally have housing start and permit data indicating that the home builders are reacting to this. So it's not just a sales boom, it's a construction boom. And this morning's existing home data, which came out literally 20 minutes ago, shows that the existing home market, has 1.8 months of supply. We finished December with less than 900 homes on the market. Which is, for a country the size of the US, almost nothing. And, the interesting part about that is that listings in December were actually very strong. You saw more homes listed in December than for any other December since 2005. So, everything is going gangbusters in housing. There's no inventory, but there's plenty of people putting homes on the market, and there's plenty of people buying them, and there's plenty of new homes in construction. And given the fact that we underbuilt U.S. single-family homes for more than a decade, dramatically underbuilt them, this can go on for a few quarters.
The one chart that really is shooting up right now, those single-family permits, we see that the acceleration you describe, it seems to be happening there. That rate of change seems to be particularly fast, and it's still very far below where we were pre-financial crisis housing bubble. What's kind of the reasonable target to have in mind for this particular figure, these single-family permits, Michael?
You're going to see the rate of change come down. First of all, it will go up and it will come down. It will go up in the first quarter of 2021 because you're going to have the COVID low kind of affecting year-over-year changes. But we're back into what I would call a high level of housing construction. It's not sort of bubble level. But we saw in 2005, if we get anywhere close to 2005, it's about another 30% from here. But even staying at these levels would mean that housing is contributing to the U.S. economy, as I say, in a way that it hasn't for the last 15 years. It's really been the missing piece of domestic economic activity for that period of time.
Michael, right now, what is the status of the kind of housing and migration trend where cities had some exodus? The trend that we see, it looks like, just from a regional perspective in terms of the housing starts, is a little bit more robust in the South as opposed to, say, the Northeast, perhaps. Is that going to continue? What are your thoughts kind of on this intra-housing story, which has been about leaving these major metropolitan areas?
Yeah, I mean, look, I do think there's a constant migration south from the Northeast in the U.S., and that's a lot about regional fiscal policy. You know, we just had Governor Cuomo's great idea to raise marginal taxes. That is the sort of thing that is pushing this migration. You know, I think it's a steady story. It's not that you're going to depopulate the Northeast and everybody's going to live in the South, but it's certainly a tailwind. And again, if we look at this morning's existing home sales market, you know, it's a reminder that in the South, overall in the country, we're still selling less homes in 2021 or December 2020 than we were in 2005. You know, but if you look at the southern region, the southern regional's housing market is now substantially bigger than it was in 2005. And as I say, this is a story which has been going on for most of the last 20 years. COVID, you know, briefly, massively accelerated it. You know, I think that sort of panic migration, you know, has ended. But I think we're going to see a sort of steady stream of people moving south and to some extent moving west. And it doesn't look as if, you know, as I say, regional fiscal policy is going to do anything to discourage that.
Michael, in terms of risks to this, it's hard for me, based on what you're saying in the charts, to kind of find a lot of holes in the logic. Frankly, it fits together pretty well. I see it in my own demographic and myself in particular, for those around me that are behind a lot of this first-time buyer trend. So what's the risk? I mean, you know, the rates are always one thing, but it seems like
cost. You know,
cost.
The risk is cost. You know, right now, you know, interest rates are super low, so, you know, buyers can afford to pay higher prices. And materials costs have gone up a lot, but they've come off a very, very low level. So they've gone from super cheap to, you know, reasonably priced. You know, I think the risks are that land prices accelerate, labor costs accelerate, material costs accelerate, and, you know, mortgage rates start to move higher versus lower. And then you have a very different equation. Then you have people, you know, you probably still have very strong activity, but you have margins being pressured by the builders, and you have affordability really coming under pressure. So you really have people stretching to buy the kind of home that they want to live in. And, you know, that gives you a market that looks much more like 2004, 2005, you know, which ended up, you know, being a sort of, you know, a tremendous trap, not just for home buyers, but for buyers of housing equity. You know, that is not where we are today. I don't think we're close to that point today. But, you know, the way things are going, you know, this post-COVID world spins a little bit quicker than the pre-COVID world. You know, we will get there at some point. You know, if things continue in this trajectory, we will get there at this point in time. So, you know, my feeling about housing is that it's not just a story for builders. It's now a story. It's certainly a story for housing construction stocks. Makers of materials have really been outperforming since the summer. It's a raw commodity story. You know, you forget how important U.S. housing traditionally was for the copper market. And it's not just a story about the builders themselves, but as I say, I think the builders have had a long enough consolidation now that you've taken some of the over-enthusiasm out of that sector. And, you know, I think they're well positioned to have a decent start to 2021, given the data that I think you're going to see thrown our way.
Michael, just to hone in on that point before I let you go, in terms of putting the overall housing view into an investment thesis, it sounds like while the home builders still are a fine place to be, that given the risk, the only risk really is maybe pricing, that you can take advantage of that risk through expressing it maybe through a more kind of pure commodity or materials trade, or maybe a home builder with just the highest margins. Is that a fair assessment?
Yeah, as I say, I think home builders are, to me, a critical part of the durable goods trade. But I think you always want to be diversified. And you know, one of the interesting things about this market is that leadership kind of switches from subsector to subsector. You know, you don't need to put all your eggs in one basket. As I say, home builders, I think, belong in a well-diversified portfolio right now. But it's not the only way to express the view that the U.S. housing market's doing well, which is itself part of the bigger story.
Okay. Michael, thanks for joining us as always. Appreciate the thoughts.
Thank you. Thanks
a lot. Michael Shaoul, Chairman, CEO, and Portfolio Manager. Always a good deep dive and an update into the housing space.